In this video, I'm going to share with you the only liquidity strategy that you will ever need. Hi guys, welcome back to the channel. If you're new here, my name's Liam, and I've been trading, investing, and coaching within the financial markets for the last 8 years. In that time, I've helped hundreds of traders get funded and become consistently profitable. And the liquidity strategy that I'm going to share with you in this video has also allowed me to get funded over $800,000. This strategy is simple, mechanical, and easy to understand. So with that being said, let's dive in. So this first thing is often the most important, yet it is often the most overlooked. So let's say that we have a clear uptrending market. And so we understand that the momentum is to the upside on this market. And so it's very important that in this scenario, we're only going to be looking for pullbacks in price, and we're only going to be looking for continuations higher. So we're never ever going to be looking for any counter trend plays, and we're only ever going to be trading with the trend. So if we have a long bias, we want to see pullbacks in price, and then we can look for a continuation higher. Because so many new traders are looking at timing the perfect top in the market. But what if I told you that you can just wait for a pullback and you can make so much more money trading with the trend to the upside? So it's our job as a trader to position ourselves somewhere within this leg of the move right here. And then we're looking at capitalizing on the expansion in price to the upside. You know, we're not looking to time the perfect bottom in the market, and we're going to be waiting for the market to show its hand after we've seen the pullback, and then we can look at riding this wave higher. The next scenario would be if we had a clear downtrending market. What we're going to be looking for is a clear pullback in price, and then we can look for a continuation lower. We're not looking at timing this market and buying the absolute perfect bottom, and we're not looking at trading counter trend in the market. Once we've seen a significant pullback in price, then we're looking for the market to show its hand. We're looking for a clear confirmation, and we're going to be looking at doing our business around this area right here. And then we can look for lower prices in the market. So just remember, if you're bearish or you're looking for shorting opportunities, you need to see price come higher before we go lower. And so this is like the absolute basic principles of the market, yet these concepts are so important. The final scenario would be if we had no daily directional bias, and that would be if we've identified that we have no trending conditions. So under this scenario, we would have no directional bias, and therefore we would not be looking for any opportunities in this market. So it's very important to know when to sit on your hands, because not every day or every session is going to be a trading session. So for me personally, I normally have around 3 to 4 A+ setups every single week. Sometimes it's going to be more, sometimes it's going to be less, but on average, it's around 3 setups per week. And this is often where so many traders go wrong, because they think that they need trades every single day in the market. And so when the conditions are not correct, so in a situation like this, traders are still looking at getting involved. They're still looking at placing trades, but at this time in the market, the probabilities are against you. And so knowing when to sit on your hands is absolutely vital. And so what we call this is a daily directional bias. And I don't mean daily as in the daily time frame. I mean daily as in what is our bias for the day? Because when we turn up to the market, we're going to have 3 potential scenarios. We're either going to be bullish, bearish, or no bias. And so it's very important to have a objective mechanical framework in order to simply and effectively identify what our bias is. And of course, I'm going to get onto this in just a moment. Okay, so now that's the absolute basics covered. Now let's look at how liquidity comes into this. So let's say that we are bullish in the market. So for example, we have liquidity resting below this swing low. We have liquidity resting above this swing high right here. So because we're bullish in the market, we need to see a raid of sell-side liquidity before we can look for a long opportunity. And so if you're more of a swing trader or position trader, this right here could be the previous day's low. And so what you would be looking for is a raid of the previous day's low, and then you can look for a longing opportunity to the upside. You know, you're going to be looking for the market to show its hand, then you're going to have a clear invalidation, and you're going to be looking at targeting higher prices. However, in a strong trending market, for example, if you're trading gold or you're trading indices like the US 500 or NASDAQ, then what you're going to find is the market doesn't often raid the previous day's low. And so then what we need is something called session-based liquidity. So for example, this low right here could be the Asia session low, or this could be the London session low. And so for example, we have the Asia session, which is from 7 p.m. until 12 o'clock midnight. And this is of course Eastern. And we have the London session, which is between 3 a.m. and 5 a.m. Eastern. And so what you can do is you can plot the range high and the range low of these previous sessions. Because what you find with assets that are very, very volatile is they often don't raid the previous day's low. And what they do is they often raid the previous session's highs and lows. And so this is how we can position ourselves on a intraday basis using the previous session's highs and lows for liquidity. And so what we're going to be looking for is, let's say this is the Asia or London low right here. We're going to be looking for price to raid this liquidity. This could be during a New York kill zone. Then we're looking for a confirmation. We're going to have clear invalidation at this liquidity sweep low. And then we can look at targeting external range liquidity or higher prices in the market. And this could be via a mechanical fixed 1 to 2 risk to reward, or you could simply use swing structure in the market. So this is what we refer to as session-based liquidity. This can also be referred to as time-based liquidity. And so this is really just where time meets price. And so for example, let's say that we are sell bias on a market. And let's say that this is the Asia session high right here. Then what we're going to be looking for during a kill zone is a raid of this liquidity. And then we can look for a shorting opportunity. Looking at targeting the Asia range low, or you can look at targeting a repeatable mechanical 1 to 2. And it's very important to note that these liquidity raids can happen before the kill zones, but it's important to note that the confirmations can occur during the kill zones. Okay, so we're looking at gold on the 15-minute time frame. As you can see, we have the London low and high plotted right here, and we have the Asia low and the Asia high plotted right here. And so the first thing that I needed to ask myself is, what is my daily directional bias? i.e., are we looking for longs today or are we looking for shorts today? And so if you're new here, this is where you're going to have to hear me out. So what I like to use to identify my daily directional bias is a simple 50, 100 and 200 exponential moving average. And this is how I identify my daily directional bias in a simple, mechanical and easy way. When the 50 is less than the 100, which is less than the 200, this indicates that we have a sell daily directional bias. And so we will only be looking for shorting opportunities. And what this does is it takes all of the guesswork out of it, because now we're not relying on 4-hour order blocks, daily fair value gaps, and all of these very subjective ways to identify a bias. And so every day when we're turning up to the market, we know what our bias is going to be. And so we know that we're expecting lower prices in the market. Because we're expecting lower prices, we need to identify buy-side liquidity. And we have buy-side liquidity resting above the London session high. We also have buy-side liquidity resting above the Asia session high. So I've actually just had my sessions set up incorrectly. And this was because I was doing a backtesting session with one of my one-on-one students. So it's very important to check that your London session is from 3 a.m. until 5 a.m. Eastern. Your Asia session is from 7 p.m. until 12 o'clock midnight. And your New York session is from 8 a.m. until 10:30 a.m. Eastern. So what I'm going to do is remark the Asia session high. So this is this high right here. And I'm going to mark that on in a $sign. So next we're looking for a raid of buy-side liquidity. And this has to occur during a kill zone. So this could be either the New York kill zone or the London kill zone right here. So right here, we've seen a raid of buy-side liquidity. And so my order was placed on the break of this 15-minute bearish candle low. This is via a sell stop in the market with a invalidation above this liquidity sweep high. And I was originally looking at targeting a repeatable 1 to 2, running this sell side liquidity right here. But as you can see, price goes on and breaks this bearish candle high. And so what I did was I removed my sell stop in the market, because at the moment, price is still showing bullish price action. And so I'm waiting. And then we see a 15-minute bearish confirmation right here. And so my sell stop was then moved to the break of this candle low. And so my order looked something like this. Entry on the break of this low, invalidation at the liquidity sweep high, and then looking at simply targeting a repeatable 1 to 2. And so I was triggered short in this trade right here, and then it was just a case of setting and forgetting this trade. And as you can see, during the New York kill zone, this trade did hit take profit for a 1 to 2. And we ultimately ran the sell side liquidity that was resting below this 4-hour low right here. So it's very important to note that everything's based on the 15-minute time frame, and this is a 1 time frame strategy. It's also very important that we could have easily got greedy right here. We could have looked to aim for the Asia session low, expecting a home run in the market. What ended up happening was price had a strong rejection to the upside, and that's why it's very important to take your profits out of the market. And that is why I like to target a repeatable 1 to 2 risk to reward. So just in case anybody's thinking that I'm cherry picking these trades, here's the analysis that was sent ahead of time to the exclusive community. Here is the exact execution of this trade right here. And here was the exact execution taken from my FTMO dashboard. And so this was a valid A+ setup, trading the only liquidity strategy that you will ever need in the markets.